Loud and clear.
Okay, all right. So, good afternoon, everyone. To all the eminent panelists and participants, thanks for joining us. Welcome to the presentation on whether the securitization volumes will make a comeback after the COVID. So, in this, we will start off with the trends in securitization volumes in the market over the past few years. We will move on to the bifurcation of the total volumes into BTCs and direct assignments. Then we will shift our focus towards the volume trends in equity securitization universe. We will then look at the split of different securitization transaction types across various asset classes and across various rating levels for equity. Then we'll also talk in between about our analytical approach. And lastly, we will finish off by highlighting some recent trends that are observed and expected in the securitization market. Okay, so this shows us the trend of securitization volumes in the Indian market over the past 7 years. We witnessed a big jump in the securitization quantum in FY18, from FY18 to FY19, during which the volume more than doubled. The securitization market was gaining serious momentum when the pandemic hit in FY21, and as a result, the transactions experienced a major setback. However, in the first 9 months of FY22, we have witnessed a turnaround. There has been a 65% growth in securitization volumes over the first 9 months of FY21. So, the first 9 months of FY22 has seen a securitization volume of 0.8 lakh crore, which is a 65% growth over the first 9 months in FY21. And despite the slight dampening effect of COVID's third wave seen in December-January, equity expects the total volume to cross the rupees 1 lakh crore mark comfortably. Although the market might not witness a full resurgence to the pre-COVID levels, in the short term, the year-on-year growth and the abatement of the pandemic's risk will certainly provide comfort to all the stakeholders in the securitization market. So moving ahead, we have in this slide the split of PTCs and direct assignment transactions in the overall securitization volumes. So if we look at the first graph, we can see that historically the direct assignments have constituted a majority portion of the total transactions. They were 69, 63 and 65% in FY19, 20 and 21 respectively. However, during the first 9 months of FY22, the share of DAs have reduced to 59%, while that for PTCs have increased to 41%. Now, this growth of 41% in proportion of the total volume can be seen as a preference towards the PTC transactions. The main reason behind this pattern is that the investors during the pandemic showed more inclination towards the relatively more secure transactions with available credit enhancement support in the form of PTCs. Moving forward, so our journey in securitization began in FY18 with direct assignments, and since then we have executed PTCs and partial credit enhancement transactions also. Now we'll focus on how equity securitization volumes have panned out over the years. So overall, equity has executed around 224 securitization transactions, including PTCs, DAs, and PCs, totaling to almost 13,000 crores. The first graph on the top left displays the volume of PTCs rated by equity over the years. Now, in agreement with the market, the total quantum diminished during FY21. However, in the recent quarters, equity has seen a growing momentum in the PTC transactions. Going forward, we expect the recent trend to continue and the PTC volumes rising further, recovering to the pre-COVID values in the near to medium term. The bar graph on the top right gives the volumes for the PCE, which are the partial credit enhancement transactions. Now, first, we would like to bring to your attention that PCs are not securitized transactions in the strictest sense. But in PCs, there is a third party guarantor providing partial guarantee, and also there is a presence of a hypothecated pool. Hence, we have clubbed it into our securitization experience. Now, the healthy rise in the PCE volumes is expected to continue because of two main reasons. One, the risk of the pandemic has abated to a large extent. Secondly, RBI disallowed covered bonds in its latest master guidelines released in September 2021. So with covered bonds going off the list of options, at least for the time being, although more clarity is required on this, originators were expected to prefer rating notch-ups through PCE transactions. The last graph on the bottom shows Equity's experience in DAs over the years. So DAs form the largest chunk of Equity's securitization universe. For DAs, after a slowdown in FY21 due to the pandemic, obviously, the volumes have seen significant growth in YTD FY22. Equity expects this number to continue growing, reaching the pre-COVID level in the short to medium term. So here I would also like to brief you about the analytical approach that we follow for rating PTCs as well as for loss estimations of direct assignments. So first we do a market evaluation, then the portfolio analysis of the particular company that we are looking at. We get the static pool from them, the dynamic delinquency as well as collection efficiency trends, and then arrive at a base case. And then we apply different stress factors. So during the pandemic, for example, we had applied stress factors for COVID as well. And after applying the stress factors, we arrive at a particular rating level for a transaction. All right, so next we will have a look at the range of Equity's experience in securitization. The first table talks about the bifurcation of PTCs rated by Equity across different asset classes and across various rating levels. Equity has experience in executing PTCs of diverse asset classes, with unsecured loans forming a major portion. This asset class mostly includes unsecured business loans and a little portion of personal loans as well. Next, in the descending order of volume, Equity has rated PTCs of secured business loans, two-wheelers, MFIs, and very recently Equity has rated a PTC transaction for a machinery loan pool as well. Equity's ratings also belong to a wide gamut of rating levels across the scale of BBB- to AA-. Now moving to the second table, it displays our experience in PCEs across the rating levels, BBB+ to single A, and instrument types, term loans, PC and NCD PC. The term loans PC form the majority portion of our partial credit enhancement transactions. Now, apart from PTCs and PCs, Equity has also executed DAs. Now, as we know that DAs form the majority chunk of Equity's securitization universe. So, we have executed DAs for pools of secured business loans, unsecured loans, MFIs, housing loans, and commercial vehicle loans as well. So, there also we have experience across a diverse set of asset classes. Now we'll focus on the performance of Equity's unsecured loans PTC transactions. So we track the PTC transactions performance on a monthly basis, and we have divided them into asset classes, and that's how we are presenting them. So the first graph gives us the collection efficiency trend for unsecured loans in the past 12 months. In May 21, so if we focus on May 21, the collection efficiency had suffered a setback due to COVID second wave, and it dropped to below 70% for us, that in the transactions rated by us. It has recovered since, showing an upward trend during the November to January 22 period. However, this improvement needs to be sustained for garnering more confidence from the market in this sector. Therefore, we can conclude that the collection efficiency, it still hasn't reached the pre-COVID levels, but it has shown signs of improvements. And the upcoming parameters, this needs to be monitored. The second graph talks about the delinquency trend. So the delinquencies for this asset class tells us that the 90 plus DPDs have started to improve, although a pattern over a prolonged period of time will give a better idea. The 180 plus DPD deteriorated slightly in January 22 due to the Omicron effect, but it is expected to recover in the short term. So next up is the performance of parameters in the MFI sector for PTC transactions. Now, we'd like to mention that because of our sample size limitations, the collection efficiency might not be fully representative of the market trend. For Acuitas PTCs, the collection efficiency stood at around 80% in January 22 collections due to the third wave's impact. However, in our FI portfolio of MFIs, we have observed a collection efficiency in the range of 90 to 95%. Although the overdue collections are yet to recover fully in this sector. So Acuity believes that recovery will happen in the MFI sector as well with a lag. The second graph gives us the delinquency trend. So the delinquencies seem to have stabilized in January 22 and they remain within the initial expectations as per our initial analysis of the PTC transactions. And going forward, we expect the performance of this asset class to improve in the short to medium term. Going ahead with our two-wheelers portfolio, now again due to our sample size limitations, the numbers might appear a bit skewed, but our two-wheeler PTCs have witnessed very steady collection efficiencies and it stood at around 97% in January 22. However, as per our FI two-wheelers portfolio, the number is more realistically at 83% to 85%. Now, along with the easing of the pandemic risks, the fuel price stability will also determine the recovery in this asset class. And how the players of this sector handle the overdue collections also remains to be seen. So as the second graph tells us, while the 90 plus DPD displayed a stabilizing pattern in January 2022, the 180 plus DPD deteriorated slightly, although not to a degree of concern for this particular asset class. So we would like to finish off by mentioning a few recent trends in securitization that we have observed both in the market and in our portfolio. Now, we have seen that despite some rating downgrades of PTCs in FY21, the number of steep downgrades were quite minimal. Therefore, we believe that PTC transactions have proven resilience through the turbulent times, and this has also helped increase investors' confidence towards PTCs. In Acuitas portfolio, there was only one transaction which had experienced an utilization of cash collateral, and that was replenished also subsequently. So this had resulted in the greater share of PTCs in securitization volumes observed in FY22, which I had talked about towards the start of this presentation. However, what remains to be seen if it is going to be a long-term phenomenon. Now, during the pandemic and the time after that, investors preferred securitizing secured asset classes such as mortgage loans, gold loans, and CVs. And we saw a gaining momentum of riskier asset classes in the DA transactions. Also, because of the impact of RBI guidelines of disallowing covered bond transactions, we might deliberate on if it will open up any alternative routes of securitization. And with respect to equity tranching, so as per the recent RBI guidelines, the MRR requirement can be met through cash collateral as well as equity tranching. Therefore, can we expect an increase in the number of equity tranching in the PTCs going forward with more skin in the game for the originator? And so that's all from my side. Thanks a lot, everyone, for your time and attention.
Thank you, Sumit. Thank you for setting the background for today's discussions. Without any further ado, we'll now move to the panel discussion. Let me introduce our panelists on board today. Our first panelist is Mr. Mahesh Goyal. He is the Chief General Manager at SBI and has an experience of over 35 years. Mr. Goyal joined SBI as a probationary officer in 1987 and has worked across India in Gujarat, UP, West Bengal, and Bihar. He is currently head of real estate and housing business unit and is based out of the corporate center in Mumbai. He has been actively involved in the bank's lending to MSMEs. Our second panelist is Mr. Sandeep Singh. He is Director, Northern Art. Mr. Singh heads the Structured Finance and Products Group. Being a fixed income professional, Mr. Singh specializes in evaluating funding options for corporates, both financial and non-financial, along with a solution-oriented approach to help corporates raise funds through a combination of on-balance sheet and off-balance sheet routes. Welcome, Mr. Singh. Mr. Ankit Jain, our third panelist, he is the Chief Financial Officer at Mass Financial Services Limited. Mr. Jain is predominantly responsible for strategic planning, syndication of funds, and resource mobilization for his company. His efforts have helped the company to enter the main financial stream of capital markets with a very successful IPO in the year 2017 that was oversubscribed 127 times. Welcome, Mr. Jain. Next, we have Mr. Sahil Mehta, who is the Chief Financial Officer at Swatantra Micro Housing Finance Corporation Limited. Mr. Mehta carries vast experience in fundraising, banking operations, costing, and budgeting. He comes with an excellent exposure in the field of microfinance. Welcome, Mr. Mehta.
Thank you.
We have Mr. Suman Chaudhary, Chief Analytical Officer, Equity Ratings and Research Limited, who carries vast experience in credit ratings, research, and risk. And Suman leads rating execution, analytical quality, and thought leadership at Equity. He has held leadership roles in ICRA and CRISIL before joining Equity. I would now like to hand over to Suman, who would lead us further into the discussion. Over to you, Suman. Suman, you are on mute. You'll have to unmute.
Thank you. Thank you, Tony. I hope I'm audible.
Yes, Suman.
The audience. Okay. So good afternoon to all of you. And first, I would like to really thank all the four panelists for sparing their valuable time and for coming to this webinar, participating in this panel discussion. I'm sure the audience will greatly benefit from their experience and their understanding of this market. Thank you. So let me, start the proceedings by just sharing a piece of personal history, if I can say, on securitization. So I was a younger analyst rather, way back in 2004. And obviously not in this company, it was some other rating agency. And I was along with another of my colleague, who incidentally became one of the stalwarts in the securitization market. We were handling these transactions, which were coming to us. Interestingly, at that point in time, not so much from the NBFCs, but from some private sector banks, foreign banks, and even one for foreign NBFC. So it was a kind of a small market those days, where the number of originators were only a handful, and some of them were also the purchasers. So it was a small, it's effectively a small market, not more than 4 or 5 players. That was the situation, what was there in 2004-5. And we can say that over the last 15 years, we have come a really long way. Of course, we can't compare ourselves to the kind of securitization market that we have seen, let's say, in the developed economies. like US. But the fact remains, and as what Sumit's presentation also saw, that we reached a high of a volume of securitization, annual volumes of almost around 2.
Suman, your frame has frozen.
2 lakh crores. That was really the exact number with me, but the number of originators in the market, including the smaller NBFCs, including the MFIs, wider market today, right? So, and also we have intermediaries in the market. Sandeep comes from one of those who have that expertise and understanding of the market, who assists client. So it's a completely evolved market, is what I would say today. There was a point in time when we know that when priority sector considerations used to drive only priority sector considerations used to drive. We have definitely come quite some transactions have all through that become. There are non-priority sector transactions also happening, right? So today we definitely are, as we are discussing in this panel, we are seeing a much more evolved securitization market in India. So what I will do is I will start with Ankit. Ankit comes from Mars. He is the CFO of, as Tony mentioned, of Mars Financial Services. And Ankit, let me start with you. In India, as you know, the securitization market has been dominated, especially over the last few years, by direct assignments from the originator to a bank or a larger NBFCs. And Mars in particular, they has been involved in a large volume of this kind of DA transactions, with the underlying strategy of originate and distribute, which also is fairly increases. It's a kind of profitability enhancer kind of a model. So from your perspective, from the originator's perspective, why are these direct assignments preferred? And how do they also benefit the purchasers?
Yeah,
so that's one thing I wanted to ask you. And another is, the other part is that, is there any impact of the pandemic on this kind of, DA transactions? And do you see that, the pandemic has led to some reluctance or a slowdown in the purchases from banks? Yes, please go ahead.
Yeah, thank you, Sumanji. So if I tell about DA, I think DA or securitization through PTC issuance has been a prominent fundraising program for all the smaller or mid-sized NBFCs over a period of last 10 years. I can permanently say after 2012 guideline came in.
Correct.
And if I tell about the belief of Mars on DA, is that we complete a value chain. We have a value chain approach. So what happened is the smaller, medium, regional NBFCs who have the niche expertise of serving the unserved, underserved, informal class of customer, because of their proximity to the ground, because of their proximity to the end customer, are able to build the volume of disbursement as well as to build up a quality assets. Now, when this quality assets is churned in the book, because what is the MHP guideline kit comes in, these loans are sold to the larger NBFCs, banks, majorly PSUs, and private banks who has the balance sheet money. So therefore, this is a value chain approach whereby the loan is created by someone, serviced by someone, and held by someone. So this completes the cycle.
Right.
If I tell about the benefits of DA transaction for an originator, preferably what we feel as a Mars is, first of all, we save on capital, because unlike PTC issuance whereby the credit enhancement is allowed, In DA transaction, it's a complete without recourse transaction. So if a assignee invests in the DA transaction, it will be without recourse to the assigner, and therefore we save on capital. First of all, second thing, it's a complete match of ALM. So because the cash flow which is recovered from the underlying obligor, which has been assigned to the assignee, only that amount has to be repaid over a period to the assignee, and therefore there is no mismatch. Because I think after this crisis in NBFC since the last 3-4 years, it has been very important to focus on ALM. So though most of the NBFC would have been focusing since before, but this has been become very important since the crisis. Also, the best benefit we see that despite of selling, the spread from these assets keep on coming to the NBFC or the assignee. So that's the best part is, despite of selling the asset, because there is a mismatch or there is an excess interest spread. So the NBFC, despite of selling, they keep on earning the spread, whatever spread they would have kept if the asset would have not assigned to the assignee. So nothing changed. It's just a on-book transaction, but we save on capital. And also, as told by you, most of the transaction are PSL transaction, priority sector lending.
Right.
So the cost of borrowing, I guess should say the cost of fund for the selling entity is lower as compared to the other borrowing, balance sheet borrowing, which help them to reduce the cost of fund, overall cost of fund. For the assignee or the purchaser, if it is a PSU or a private bank, majorly this loan act as a bridge for their PSL targets. It helps the NBFC, larger NBFCs who do direct assignment transactions, as well as banks to have a growth, as well as the most important thing which I think never highlighted is that they can book the retail asset in their book.
Right.
They have the priority sector target, they have the growth target, but the retail asset is booked in their book, which is a major target for I think almost all the PSU banks. Also, what happened is, because this is a seasoned portfolio which is assigned to banks, therefore the asset quality remain far better as compared to other loans, and the operating cost associated with it is far lower. So this is how the originator is benefited as well as the assignee is benefited. If I tell about after the pandemic,
Right.
so last 2 years, because of pandemic and because of multiple lockdown, statewide lockdown or nationwide lockdown, I think every product, whether it's a MEL, SME, two-wheeler, commercial vehicle, even housing, that the income of the underlying obligors have been affected, which has resulted into asset quality deterioration. For some NBFC, it will be far harsher. For some NBFC, would have been lower harsher, but all of them have been affected. So because of these reasons, the volume of DA, even securitization, to some extent has been reduced. But the other way also is there, because of this pandemic started in March 20. So almost major, smaller, and medium-sized NBFCs were flushed by liquidity.
Correct.
And in the first 6 months, because of moratorium, because of focus on collection rather than disbursement, the focus was not on raising new funds, but the focus was on collection. And because of the excess liquidity, the transaction reduced in the first 6 months or even in the last year. So this is on the, but if I say you, bank, every PSU bank or private bank have done assignment transactions last to last year. So what they've done is they pick and choose the preferred NBFCs for the transaction. They have stringent their selection procedure, selection criteria for the underlying loans, and even they prefer the products. according to which they have done the transaction, whether in the last year or last year. So this is all about the transactions.
Okay, thank you so
Thank you.
much. Thanks, Ankit. I think of these direct assignments and how they have helped to evolve and diversify the securitization market away only from PTCs. Absolutely. So what we will do is we will go to Mr. Goel. Goelji, we will ask you about direct assignments from a perspective of the bank. Ankit talked about from the originator perspective. So SBI has been, sir, fairly active in purchase of loan pools, retail loan pools through direct assignment transactions, as we understand. How has been, sir, the experience of the bank with respect to these transactions, particularly in the housing loan segment? And in the pandemic period, is the bank a little cautious? And have they stayed away from these transactions? If you can give us some perspective on that.
Thank you very much, Mr. Suman, and thank you, Equity. In fact, we had been there in direct assignment since long, and the experience so far has been good, whether it is microfinance direct assignment or housing loan. Like I am dealing in housing loan, but if we compare with the total our AUM, direct assignment portfolio is very minuscule. Say for my housing loan portfolio of 5 trillion plus, direct assignment portfolio is just 10,000 crores, just 2%. Can you hear me?
Yes, sir. Very much.
Okay.
Yes, sir. We can hear you.
Yeah. And in fact, as rightly shown in the PPT, 16, 17, and 18, that was the peak time when the direct assignment was on this high side. And the benefit for the bank in direct assignment is like we are getting pool in one go, and the collection efficiency is comparatively for these all these NBFCs and small housing finance companies better, and their NPAs are much under control.
Right.
So our main task is that the company should be well rated. I think A plus is the rating
Rating
requirement, and the NPA should not be more than 2% in that particular AUM.
Right. Okay.
So that is one part. And as far as the pandemic is concerned, during pandemic the direct assignment was low. It's not because that we were not interested. The pool was not available because there was no fresh disbursement from the NBFC and HFCs, and whatever the pool was there, that was already assigned. So new pool was not available with the HFCs. So that was one of the main reason that direct assignment was down during pandemic. And as far as recovery or collection is concerned during pandemic, so whatever the moratorium allowed by the government or regulators, that was there. Otherwise, our experience so far has been good only.
Okay.
Not except for the companies, SFCs, those have those which are failed, like 2-3 NBFCs and SFCs not doing well,
Okay.
and they are being taken over by some other NBFCs, some other groups. So they
Some
are
isolated cases.
isolated cases, yeah. But overall experience is good.
Okay. Okay, great. Sir, I think you have to leave early because you have some other meeting. So
Yes,
what
sir.
I will do is I will ask you another question at
Sure,
this point.
Sure.
Sir, in terms of the DA transactions, do you see any regulatory challenges, or there are any technological challenges that you face while kind of handling this DA transactions?
Yes, there are regulatory challenges, no doubt about that. PTC as compared to DA is little easier.
Easier, right?
But PTC is part of investment. Right. It is not part of our loan book. Whereas DA is part
Correct.
of our.
The treasury is handling
Treasury is handling PTCs. Okay. like we have to have mirror account of individual borrowers. That is a big challenge. And then we have to reconcile our book and the book of NBFCs. So that is being resolved with the technology, support of the technology. Not a very big issue, but that is a challenge.
Okay, okay. But this will not, kind of slow down your kind of purchases of, loan pools from NBFC.
Won't. We are coming out with
Okay.
with the changes in the technology to support the requirement of the regulators.
Correct. Sir, the last question to you is also on, there is this new platform or, arrangement that has come, which is called co-lending. So where NBFCs are also, many of them, they are kind of participating in a co-lending arrangement, where origination will be by NBFC, but 80% contribution will come from the bank.
Banks.
If co-lending it takes off in a big way, do you think that direct assignments or overall it can impact the securitization system or the securitization?
Definitely. Yeah, if co-lending becomes very successful in going forward, then naturally the securitization might get affected, because co-lending is, I feel it's better module, because that underwriting is as per the requirement of the bank right from the day one.
Right.
And again, the rating of the co-lender and the collection.
Right.
Yeah, all these things are considered right from the day one. And we are exploring more and more co-lending going forward.
Okay.
Rather direct assignment.
Okay. Sir, you think that co-lending will pick up in a big way, because we have been hearing, about co-lending for the last 2-3 years.
Yes, it will pick up. Definitely.
Okay.
Especially in those areas where bank is not there.
Right.
Like for underwriting, from bank's point of view, any home loan, we need a income proof. Without income proof, like without ITR, we don't sanction loan directly.
Right.
Whereas in case of co-lending, there could be some relaxation there, where they are financing small value, and they are doing assessment in their own way. Like they have their own way of assessment, and they're sanctioning loan in the range of say 10 to 20 lakhs.
Correct.
So in those areas, in those locations where we are not there in direct financing, there we can approach.
Right. True. It will, in other words, it will help in financial inclusion.
Definitely.
Is what you were saying.
Yes.
Covering segments or people in the informal sector in a way.
Informal sector, correct.
Right, sir. So we will move to
anything else from the.
I think this is from our side. I think thank you so much for coming and spending some time with us. Definitely, we are active in the securitization market as Equity, and we have rated some of those direct assignments where SBI also has been a purchaser. Correct. So we will continue to be in touch with you.
Sure. Thank you very much.
Thank you.
Thank you, sir.
Thank you for coming. Sahil Mehta of Swatantra Microfinance Group. Sahil, good afternoon.
Very good afternoon.
Good afternoon. As an experienced finance person, you have been in Treasury. How do you view securitization from an originator's perspective? In terms of benefits, is it just a financing option, or it has many other benefits? How do you look into it? And
thanks
from microfinance sector's perspective, because you come from that sector, microfinance sector's perspective.
Many thanks, Sumit. Pleasure to be here.
Can I request you to switch on your video? It's currently.
I'm facing some technical
Oh,
glitch.
okay.
I've asked my IT team.
I see.
Okay, no problem.
No problem. Please go
Please
ahead.
go ahead. Please go ahead.
Many thanks, Sumit. Pleasure to be here. Many thanks to the Acuity team for inviting me in this webinar.
Our
Coming to
pleasure.
the topic and your specific questions, I would like to start with a quote that success is best when it is shared. So I would like to relate this to securitization. That securitization through DA or through PTC, it brings benefits both to the originator as well as the investor. And it's a win-win situation for both the parties. So as a finance professional in today's business environment, what I believe that one of the key elements as a finance manager is the creation of a value for the organization. And as a treasury guy, one has to play very innovatively on liability side if they want to create value for the organization. And here securitization as a tool through PTC or through DA comes very handy if you have to manage your liability side innovatively. Now securitization, it brings various benefits to the originator. If I have to list down some benefits, so number one, it gives access to the relative low cost of finance. It brings in diversification of funding source, thereby access to the liquidity. Further, it helps in freeing up your capital. Like it helps in removing risk-weighted assets from your balance sheet and thereby helps in maintaining a better capital adequacy ratio. So it acts as a very effective balance sheet management tool for any organization. Further, if we explore, it unlocks and identifies some other benefits, like it helps in since it comes with a fixed coupon, it helps in managing interest rate risk. Then if we see, like there are certain asset classes like housing finance where tenor is on higher side, it helps in better asset liability management. This funding option comes up with a better asset liability management. And again, it helps in enhancing return on capital. Now on investor front also, as I was saying, it's a benefit to investors. So it provides them apart from that priority sector lending benefit, which you have discussed earlier, it provides them a safer investment avenue as compared to the other option. Now coming to the microfinance part. So over the last 10 years, we can see that there has been a robust growth in volumes of securitization transaction in the microfinance sector. Overall, if we see across all the sector, microfinance has contributed the second highest volumes in terms of funds that has been raised under this route. So overall, depending on the funding strategy, any microfinance MFI, I'm talking of top 10 MFIs,
right?
Normally 15 to 25% of their overall funding requirement comes through either through PTC or through direct assignment.
Okay. Quite a significant amount.
Yes. And one of the important aspect I would like to bring here, that how microfinance MFIs are in demand when it comes to direct assignment or PTC. So with respect to the overall priority sector requirement of 40% for any banking institutions, so they have to maintain 18% through agri or agri-allied activities.
Absolutely.
So here, if we can see overall loan portfolio of a microfinance sector, it contributes almost to 60% of agri-allied activities. So here, I will say that MFIs, like they play a very important role and they are always in demand.
Right.
So overall, like these are the benefits I think which it brings on the table, both to the investor side as well as to the originators side.
Right. Very true. In fact, microfinance has come a long way, Sahil. As you know, in 2000, if I remember right, 2010, 11, that we had the Andhra crisis, right. And there were portfolio losses. And after 10 years, I think the situation is different. The investors and the lenders, they are much more comfortable, I think, with the sectoral exposure today, although it is an unsecured loan. but I think the resilience in the sector has definitely improved. While there will be risks in every kind of a lending, but the resilience that we see today in the sector, that has definitely increased.
I totally agree with you. So like it has been one of the most resilient sectors. If we see last 2 years, so like microfinance sector has been the most resilient sector. So overall, if we see the collection efficiency trend, it has improved a lot. So like if I talk of top 10 MFIs, we are witnessing a recovery rate of more than 96%. And whatever has been disbursed in last 12 months,
Right.
the recovery rate is more than 99.5%. So one of the important aspect here is that the economy of the microfinance clients is majorly dependent upon the basic amenities. So impact, if we see in last 2 years, has been minimal, because you, me will require food, you, me, or any other person will require meal.
Right.
But like if we compare this to the luxurious item, we might delay our decision if I have to purchase a car.
True, very much.
And here also, if we see the businesses where these microfinance clients are involved, the gestation period with respect to their businesses is very low. Like they can restart their business in one day.
True.
This is how like I believe that microfinance sector has been the most resilient sector, and securitization in the past has played, currently is playing, and future will play a very pivotal role in overall funding strategy of any microfinance institution.
Great to hear that, Sahil. So now I will turn to Sandeep. Sandeep Singh is a senior director in Northern Arc. Sandeep, you have seen the securitization market from a very close quarters, over the last so many years. Do you believe that this COVID pandemic, in particular, which has been with us for the last 2 years now, it will have any lasting impact on the securitization market, or the investor appetite will remain strong, or it will come back in a big way? Second part of the question is, how do you think the RBI guidelines, the revised guidelines, which came in September, how will that impact or kind of affect the market? If you can touch upon these two parts.
Well, thank you, sir, and thanks Acquite for this great privilege to be part of this webinar, and also with very accomplished fellow professionals, listening to their views. So this is a great opportunity for me as well to listen and, gain more knowledge. And coming back to your first question, I think you are right that because of the pandemic, the securitization volumes have significantly come down in FY21 and FY22 also, after a 2-year good run between FY19 and FY20, when the volume was close to 2 lakh crores in both of the years, with slight difference. But in FY21, I think the volume was very low at 85,000 or 90,000 crores. And FY22 also, we should at least, as of 9 months, the number should be more like 75,000 crores. So that is definitely a 60% jump compared to 9 months of FY21. But if you kind of look at 9 months FY20, it's just half. So that just speaks of the potential. 9 months FY20, the numbers was more like 150,000 crores, while we have probably clocked 75,000 crores, in the 9 months FY22. Having said that, I think it is our firm belief and optimism that the securitization markets will come down to bigger volumes in FY23 and 24. And there are a number of reasons for that. Typically, investors who invest in securitizations, it's a non-recourse lending to them. So they have only access to the underlying pool, and the repayments from the underlying borrowers. Hence, they have to be very sure about the repayment track record. But obviously, during the pandemic, because of restructuring of loans, moratoriums that were provided, and let us say, even though the moratorium, at least on record ended, in September 2020. But even then, investors were a little wary in the sense that whether the guys or the borrowers who had sought moratorium were having a strong enough credit profile to be able to repay. So there was a, you can say, a watching period, that was maintained by a lot of investors, that let's see how people who came out of moratorium, and the extent of analysis went up to like, whether the moratorium taken was for 2 months out of 6 months, or 3 months out of 6 months, or 6 months out of 6 months, and all kinds of, analysis was done at that time. So naturally, this kind of, delayed or reduced the volumes of securitization in FY21. In FY22 also, I think what has happened is, typically learning from past events, NBFCs have maintained high levels of liquidity and capitalization also, and have been quite, I would say, careful and cautious in terms of doing disbursements in down cycle scenario. And that has resulted in lower asset creation, so to say. Having said that, we believe that FY23 asset creation will improve as we leave the pandemic behind us. And if NBFCs clock, let's say 10 to 12% AUM growth rate across the table, some higher also in FY23, securitization as a option in the funding mix for NBFCs is not going to go away. It for the reasons that Ankit and Sahil mentioned, and the benefits that it provides, it will remain one of the important tools for funding for many NBFCs in the coming year. And I would also add that besides obviously the volume question, which nobody in particular controls, but I think it is the quality of securitization, and that would be measured in many different ways in terms of whether the market is attracting new investors, whether we are coming up with new products or asset classes. And there, I think Northern Arc is trying to play a very central role. So like I think Sahil said, and he was right, like microfinance securitization, when it started, it was like 2% of the overall issuance volumes in 2010, right? And then it has clocked close to 15-16% of the overall volumes at least 2 years back. Now it is down to 10% because of slight stress that may have happened during the COVID pandemic. And one of the key differences in which we kind of measure or see the benefit of securitization is whether there are multiple investors in a single transaction. Because for a long time, Indian securitizations used to have just a cash collateral and then senior tranche which was getting issued. So that in a way is a reflection of some sort of a collateralized or a secured borrowing, because it's like somebody is giving cash and borrowing funds from a single entity. The benefit of securitization, given that we can slice and dice and create different tranches, is to have multiple investors, who are all part of the same transaction, and leads to standardization of, the lending agreement, etc., and a common lending arrangement. So all that benefits would be key as we go along into the market. But it is my belief that the volume should continue to improve, and securitization as a funding option will remain a constant in the coming days, and the market should continue to use it as it has used in the past. Coming to your second question on how do we think that the new RBI guidelines is going to impact the market? I think RBI has done a number of things with these new guidelines. One, it has consolidated all the past guidelines that we have in this respect. So it has consolidated the 2006 guideline, 2012 guideline, and it has also consolidated the reset of credit enhancement guideline all into a single place. Sorry, sir.
No, please go ahead.
Oh, sorry. I thought you were asking something.
No.
So basically, I think RBI in its September 24-20 last year's guideline has consolidated all of those guidelines. And these guidelines are also important in the sense that they come in the aftermath of implementation of Ind AS, for NBFCs. And so there was always this confusion on what happens if consolidation happens and all those things. So, right. So these guidelines in a way, kind of, we turned the corner with these guidelines, because this consolidates every piece of learning that domestic participants have learned or, had to unlearn, so to say, after a lot of changes that were, happening on the side. In terms of key impact, besides this, I believe that there are opportunities for NBFCs themselves to become large investors in securitization paper, because now RBI has come up with a differentiated risk weight for investments which allows securitization PTC investments to be a much more capital efficient investment, for NBFCs, unlike earlier when risk weight was always 100%. So that I think our belief is would lead to a alternate class of investors who would increasingly participate in investing in not just as an originator but as a standalone investor also in this market. That's, I think, point number one. The other important benefit is the number of clarity that the RBI has provided in terms of trade receivable securitization, giving clarity on that replenishing structures are possible and people could do revolving structures. So that has added to a lot of confidence on part of the markets to go ahead and explore those structures. So that I think is second. The third thing is also nudging the market into reducing the barrier to entry by introducing simple, transparent, and comparable securitization. So RBI, in a way, has kind of enabled and nudged market participants that you may want to reduce the barrier to entry, and that will lead to a more efficient and deeper and a wider market if more information is made available to investors. And the setup cost for investors is not as high if they were to be interested in a transaction. So I would broadly say that RBI has done a lot of enabling things with this, with the current master directions. Some of the impact may be seen in a slightly longer duration of time. It may not be like apparent in the volumes right away, but my sense is that used appropriately, this will have a long-term benefit for the markets.
Right. Apologies. I think in between there was some network issue at my end. I hope I'm audible, Sandeep.
Yes, sir, you are. You are.
Okay. Okay. I think very pertinent point we discussed on the impact of the RBI to improve the efficiency of transactions, the way it can help to bring in more investors. I think these are very important measures which over the long term will help in development of the market. I think at the end of the day, it is more about improving the breadth of the market, bring in more participants, and and having more buyers and sellers, we can strengthen the market, right? So that's what we hope will happen. I will go back to a specific.
There seems to be some network issue. We are losing you intermittently. Sorry, Suman is experiencing some minor technical glitch. We're just trying to resolve that. Just hold on for a minute or so.
Hello.
Yes, Suman, you're audible and clear.
Yeah. Is it better now?
Yes.
Okay. Sorry. Sorry, I think Ankit, I was in between impacted because of this network issue. Can you hear me now?
Yeah, Sumanji.
Ankit, you are on mute. Yeah. So I was just asking you about your asset class performance during the pandemic, because there were a lot of challenges that many of the NBFCs faced during this period, and moratoriums were provided. Some loans have also been restructured. So do you see that stress that was there during that pandemic period, do you see that coming down right now? Is there a clear visible trend? Are therefore lenders more comfortable? How do you see the situation evolving?
Yes, Sumanji. So if you see because of pandemic, and if you see because of pandemic, national lockdown and other stuff, almost all of the products, whether it's MEL, SME, two-wheeler, commercial vehicle, even housing, all of them affected because of COVID pandemic. But of late, if you see last 6 months, the economy is again reviving, and therefore, if you compare any industry, the collection efficiency is again improved, and yeah, even the third wave has gone away, but there was no major impact of that on the collection efficiency on any of the for any of the products. So we see that as per the ground uh, reality or the ground details coming up, the collection efficiency is improving. Thereby, the asset quality has improved for almost all the NBFCs, and now which will lead to a better asset quality over a short term. So we see that in the next 2 quarters, the asset quality will remain will be all the collection efficiency will further improve, and the asset quality will further improve there too. Sumanji, I think you're mute.
You're on mute. You'll have to unmute.
Yeah. Sorry. I'm audible, right?
Yeah.
Okay. So clearly, that is one of the comfort areas for the investors and lenders, because they're seeing that improvement. In fact, as a rating agency, and as Sumit presented, we are seeing a gradual, I wouldn't say a very sharp improvement at this point in time. It is taking its own time in some of the asset classes, but there is a very distinct improvement in collections, improvement in the delinquency buckets that is visible. And this is definitely something that will increase the confidence of the bankers and the investors to start looking at transactions very actively. In fact, March end, as you know, is a very busy period, and we are seeing that there are investors who are active, and probably we will see much more transactions than we have seen in the last few quarters. Yes. So I will go. Yeah.
Just to add on,
Please.
because this is the right juncture to invest either through direct investment securitizer. Because if you see per se, already the sector has been affected over the last 2 years, and now we see from where we see the asset quality will be improving over the period. So I think this March quarter or even the next 6 months will be a peak period for I think direct assignment as well as securitization transaction per se.
Right. That is very encouraging to hear, Ankit. I think the market needs a lot of impetus. I think it has been down for quite a while now. I will go back to now to Sahil. Sahil, again, similar question to you. As far as the microfinance sector is concerned, there were, I would say, a little higher concern on the microfinance sector, because of the impact that the pandemic had on the informal sector. Rural economy also, as we are seeing, it has impacted the rural economy. So, and we also saw that some of the microfinance sector, if you look at their portfolios, specific companies, they have seen an increase in delinquencies. Do you think that the pain in the sector is going to continue for a little longer time, or things have already started improving?
Thanks, Suman. So I would like to start by saying that things are touchwood, like things are improving and collection efficiency across the sector has improved. So if we compare the third wave with first and second wave, the impact during first and second wave was on a higher side, because at that time, what we have seen, the lockdowns were more stringent as compared to the third wave. So what has happened in microfinance during first and second wave, on account of lockdowns, the people, they were not able, they were facing the logistics issue. In microfinance, personal touch is very much required. So we do have our collection meetings where, like, our field officer, they go to the field and they meet client and they take EMIs from our client. But during first and second wave, the impact was on a higher side because lockdowns were very stringent. People were not able to move freely from one district to the other district. So here, one of the critical aspect, if I see entire microfinance sector, if they have to de-risk, they have to focus on diversifying their portfolio across various districts. So if I talk of our company, right from the very beginning, our focus has been diversifying of our risk across various districts.
Right.
So we do not, so as a percentage, we have a policy that we will not be more than 2% in any of the district. So whenever some problem has happened in microfinance sector, we have seen it is in certain pockets. So that plays a very important role. So currently across India, we are saying there are certain states where, like, microfinance sector are facing certain challenges. So one state is Assam, but overall, if we see other states, the collection efficiency has shown a significant improvement. And as we are going ahead, as I earlier I have also discussed that whatever loan has been disbursed in last 12 months, we are witnessing a recovery rate of more than 99.5%.
Excellent. Okay. Right. So that's very heartening to note. And, I think you mentioned a very important point, Sahil, on the concentration risks.
Yes.
And this is a very important element in our criteria on securitization and our methodology, when I think Sumit very briefly explained. But what we do is that we look at the distribution of the pool and the portfolio in different districts and different states. And if it is largely concentrated, then there is the stress factor that we build in, that is higher because of, as you said, of the empirical evidence that typically it can, the problems can arise in pockets. And so we can't, in a securitized pool, I think the investors and the lenders would be far more comfortable in seeing a well-distributed kind of, exposure rather than any particular concentration. So very, very valid point that you have raised on this. I will go back to Sandeep. Sandeep, new products is in securitization has, is always something that one looks forward to because it adds depth to the market. One particular product, although technically I can't call it, we don't call it securitization. It is on balance sheet, which we the PCE transactions, as they are referred to, partial credit enhancement transactions. We are seeing, we have been involved in some, but the market has been doing much more. We are seeing an increase in those transactions. And we are also seeing, players like you kind of acting as the credit enhancement provider. So how do you see this product kind of evolving? And do you see a big kind of prospect or opportunity, particularly in this segment?
No, I think this is a very important question. And when we talk of structured finance, obviously there is what we call retail, PTC securitizations, which forms the bulk of the discussion around structured finance. But typically, structured finance also consists of other transactions, like the one you pointed out, the partial credit enhanced loans or bonds and other structured instruments that can be like some sort of an hybrid instrument. It could have structural elements, but it could be on balance sheet and not necessarily off balance sheet, right? So I think one of the key reasons why this product has come into being is to meet a real need, in the sense that when you approach securitizations, you get a matched funding, which is again dependent on the tenor of the assets that you generate. So essentially, if you're doing mortgages, right, you would get a funding which is commensurate to the mortgages that you originate. Neither less, neither more. It will be completely matched in terms of repayment. However, I think this allows issuers to basically take non-matched funding. So let us say somebody is originating microfinance loans and the tenor is broadly 18 months, but they are looking for a 2-year tenor. Typically, let us say because they want to kind of meet a certain ALM requirement for their balance sheet. So essentially that I think is one of the key reasons for entities wanting to do this and seeing this as a viable option, as opposed to trying to do a securitization where also they could provide cash and get an enhanced rating. So that I think is point number one. But I think one of the bigger reasons for this product is also the fact that we typically, as one of the key arrangers in the market, and given that we have close to more than 175 small to mid-tier to large NBFCs that we work with as partners, and who have been on our portfolio, both in terms of term loan exposures for the whole of last decade or so. So we typically have a very close relationship with them, have a very close understanding of the risk. Typically we do a head office, branch level and other monitoring visits, and try to understand the MIS, the loan management system, the everything that goes into a company's lending platform at much closer detail. And hence, when we guarantee or provide a guarantee to some of these transactions partially, investors take that extra comfort because of the due diligence that we have done on the entity. And if we have kind of guaranteeing part of the exposure of the investor, they see it as a big signal that these guys would have surely done the job, much more carefully, because the setup cost for every investor to go and do a due diligence on every entity is just too high. So I think we try to address all these problems. One is based on the comfort that we have, we provide the guarantee, and other investors. So typically also what happens for investors is they have a certain quantum that is allocated at a particular rating level. So it could be like so much amount for BBB category, or even let's say BBB minus or BBB plus. But the quantum is kind of increases if the rating for that entity or for that instrument goes to A minus or A. So essentially they are able to fill up the investment buckets in those rating categories as per their investment guidelines internally. So that also is met through this product, and it has broadly found resonance with rating agencies also as a product. And I think rating agencies also fully agree and with the concept of why the rating is getting notched up. Essentially, it's the benefit of the guarantee plus also the fact that the pool is being used to prepay the bonds. And since we know that defaults have a term structure, so the probability of default also reduces if you prepay the bond, on the downgrade of the entity. And because when you prepay, the tenor of the bond reduces, and that reduces the PD, that in turn improves the rating of the instrument. So I think investors, rating agencies, issuers and investors all are finding this instrument to be quite useful. Typically, we have seen that this forms close to 20 to 15% of our quarterly pipeline. So whatever we run as arrangers in the market in any particular quarter, for investors. And since Northern Arc is one of those dedicated placement managers that kind of has focused on securitizations in a big way in the last 10 years, introducing so many of our own microfinance partners when they were really, much smaller than what they are today, to vehicle finance originators and all those players. So typically we work in a partnership with all parties to evolve this solution. So I would not even say that this is something that we did on our own. I would say that this is like coming together of market, participants, the combined wisdom of the whole market, that makes some of this possible. But I think this is a useful product, and it kind of meets, like I said, one of the needs of issuers, which is to have, feel a certain, a tenor of funding, which may not be possible purely from assets.
Right. I think that you have explained it quite well. What I think what I understood from what you said is that the investors, they or the lenders, the fact that you as a specialized kind of a market participant, your understanding of the microfinance, let's say microfinance sector or small NBFCs, and your methodology of doing due diligence, that itself is a big comfort factor. And your skin in the game, because you are providing that credit enhancement, that itself is also giving that comfort to the investors for the investments, and it's developing this PC market. Also, it's also a kind of a developmental role, and I really appreciate this, because once that comfort comes after some investments, then they will be more comfortable probably to take exposure directly to PTCs or to the standalone credit rather than through PCE. So
Absolutely, sir.
Right. I think this is something which is interesting, and as we speak, I understand that there is a pipeline. I just came to know there is a pipeline of transactions that you guys are working on the PCE side, as I understand on margin. So good on that. We will just quickly have I think one or two questions because time is running out. Maybe I will ask Sandeep only about the fact that, earlier, as we have seen, that in securitization, banks and mutual funds, when you are talking about PTCs, also banks, treasuries have been the investors largely. And then you had the mutual funds. Some of the mutual funds had been investors, although they were also part, at one time, as you know, they were plagued by the taxation issue. But they have been investing in bits and pieces, may not be in a very, very big way. But do you see that new investors will have started to come in this market? They are investing, for example, HNIs or family offices or funds. They are also kind of wanting now to invest in securitized papers, considering the fact that the yields are a little more attractive compared to what they will get in vanilla papers.
No, I think it's an absolutely great and I would say a timely, relevant question for today's discussion. I think there is a big movement afoot as we speak to expand the investor base, to bring in other alternate investors, and those could be other wealth managers, who manage HNIs, or it could be HNIs directly. So one is reaching out to new alternate investors like wealth managers, etc. And we are increasingly seeing them getting interested in PTC transactions as a form of yield pickup. Separately, I think what Northern Arc has also done is to basically, we have launched our own, platform, which is Altify, where we list all our key investment in terms of debentures as well as PTCs. And the idea is to kind of make these investments as some sort of small ticket, small size, investment options. It need not be like 10 lakhs as per ticket size, but maybe it could be like, 1 lakh or 10,000 rupees also, which will allow more diverse investor base to kind of come in and invest in some of this. Obviously, one has to be a little careful in terms of investor education and some of that when it comes to retail investors. The other investor class, that, like I said, is the wealth funds, etc. And besides that, obviously, I think there would be other steps that would be required. So let us say right now the investors that we talk of, and one of the key investors that is already there and probably is less acknowledged is NBFCs themselves.
Right,
So
right. I was
actually,
about to say.
when people talk of securitization, people typically remember like pre 2008, banks used to be originators and there would be other investors. Post 2008, it was NBFCs as originators and bank as investors. But I think the whole cycle has changed and people have become much more open and I would say welcoming of very differing strategies that different NBFCs follow. So it is possible for an MSME NBFC to take exposure to a consumer finance NBFC's pass-through certificates. We are currently running a deal where equipment NBFC is wanting to take exposure in a consumer finance NBFC's PTCs. So it's happening in many different permutations and combinations. And the idea is that people first want to have a greater understanding of how asset class performs. Second, it allows them to put their liquidity to good use at a good yield with other NBFCs who may have funds to do those investments. So that I think is one of the biggest. I don't have an exact number on that, but NBFCs are definitely one of the big investors right now. Besides banks, when it comes to securitizations. So yeah, I think I would stop there. But yeah, one last thing I would say is that obviously I think we have to look outside India's financial system if you have to grow the market, and that's where I think foreign portfolio investors become more important. And I think that's where I think some of the work lies, in the sense that securitization is a multidisciplinary topic, right? It's not just about regulators. It's about taxation laws in terms of withholding tax. It's about how we kind of make, let's say, insolvency regime available to foreign investors. How do we bring down the barrier to entry, all of that. So right. So I think all of those will actually go to a long way in kind of making the whole market a more developed market in all every sense of the word. So I'll stop here and I'll stop here for a moment.
You're on mute.
Yeah, we are almost running out of time. I would have wished to ask a little more questions to all the panelists, but I guess we need to now go to the question and answer session. There are a few questions that I understand, so we will probably take that, if that is okay with the panelists. Right. So I think let me just go through the questions first. There was one question, if I remember right, that was on asking about this was a question more to equity, I think, that what was the reason. Sumit mentioned that there were a few downgrades that happened during the pandemic on some of the PTC transactions. And I think the question that came was, what was the reason for these downgrades? What exactly were driving the downgrades? So let me take that question. I think mostly we haven't seen, Sumit, you can correct me if I'm wrong, but I don't think we haven't seen in our portfolio too many downgrades happening on the PTC transactions. Their performance, as you mentioned in some of the charts, that their performance has been relatively stable. There has been no utilization of the cash collateral. So our tools have performed relatively better. But yes, in the market, there has been some material number of downgrades. And that was expected because the stress that had built up in the retail sector, that was very, very material. So that had actually led to collection efficiencies, or the collections that I was envisaged vis-a-vis what actually happened, that was hugely different, and that is the reason why the downgrades have happened. As far as we understand, there were not a large number of what you call utilization of cash collateral. Very few cash collateral, very few transactions had the utilization of cash collateral. In fact, we were trying to research that and we didn't see any material number of significant takeaway, that we had a prolonged pandemic of almost 2 years, but we didn't see, I think, a material number of PTC transactions which went down to default. This has happened in the past. There was scenarios where CV sector went through its downward cycle, and there were some of the transactions, PTC transactions, which defaulted. But we haven't seen that happening in any material scale this time. So yes, I think it was more of collections coming down on the pools, but not so much on the utilization of cash collateral. That's one of the questions. I think one question that probably Sandeep can answer better. It is related to the covered bonds. We have seen covered bonds. Sandeep, kind of market. It was growing. There were some transactions which happened. I believe the guidelines that have come that doesn't make these transactions that feasible. So would you say that the regulatory concerns on this product exists, and therefore that's a challenge? Or do you see that this can kind of revive or maybe come back in some different form?
Yeah, I understand. I think it's a very pertinent question in the sense that, I think there is a little bit of, I would say, confusion also. I would first start by clarifying one thing. I think the RBI has not expressly, prohibited or banned covered bonds. I think that is what most of the market is arriving at by way of deductive.
So it's a wrong perception. It's probably a wrong perception.
Yeah. No, maybe the perception is right, but it's not written in so many words. So essentially what I'm trying to say is that people are arriving at that conclusion based on deductive logic, which is to say that they have just said that asset transfer will be limited to this set of counterparties, which is, let's say, number 1 to number 6 NBFCs and banks and all of that, right? So the fact that they have stopped, they have not mentioned, SPVs, to which assets can be assigned, that really is leading people to think that they have prohibited. But yes, it is true that, the fact that you cannot assign assets to the SPV makes it a little difficult to structure, in terms of if assets are not assignable to the SPV, then the bankruptcy remoteness question, completely falls, right? Or crumbles, the logic.
Right.
And if the bankruptcy remoteness logic crumbles, then the ability to enhance the rating, at least by 3-4 notches also crumbles, which does not, in turn, make it an alternate instrument that is on balance sheet, but still benefits from a higher rating and improves the borrowing cost for the issuer. So I think that is where the whole issue is. I mean, some people or councils have even said that, this transfer is very different from a transfer that would happen, let's say, in a direct assignment, because in a direct assignment, the transfer is irreversible, right? It's like a new person or a new entity becomes the owner of the asset. But here the transfer is reversible, subject to the investor getting all their funds back, right? So it's like assets are transferred, but if the issuer repays all the obligations, the assets come back to them. So I mean, there are different ways in which people are trying to interpret this. Some people have the opinion that it is difficult and not possible. Some people have said it's possible because this is a reversible transfer. It's like, pledge of assets subject to repayment, the pledge being removed. But yeah, the jury is still, kind of to decide. So we'll have to wait and watch how this whole, market develops when it comes to covered bonds.
Correct. I think globally, as you know, as some of us know, globally, covered bonds is a large market. That is what I understand. For example, in Germany, whatever little I know, I mean, covered bonds is a very large market. So, so we would have liked to see something like that here of course, with their checks and balances. So let's hope that we will see that some different way of bringing covered bonds, of course, with the right checks and balances, so there is no kind of systemic risks that arise because of these transactions. I think that's one part, and other part maybe, Sandeep, is also that these are complex instruments, so there has to be specialized investors for this, and it cannot be retail. This is not a product, let's say, for retail investors. So probably that is something the regulators also have in mind, that they want to ensure that these products don't reach to the retail investors who may be attracted to it because of the higher yields, but they may not be able to comprehend the risks. Right. Hello.
That's absolutely correct.
Yeah.
Yes, sir. Yeah, that may be one of the reasons. Absolutely.
Right. So there is another question that has come. Maybe this is the last question that we will take. With new RBI guidelines not recognizing over-collateralization as part of the MARR requirement, minimum retention ratio, will it impact PTC? This is something maybe, Sandeep, if you want to answer, or Ankit. What is the, let's say, there are originators and NBFCs who don't want to put in that requisite amount of cash collateral. Then what is the solution? So is that something that can impact the PTC issuance?
I think Sandeep would be a better person to answer, but just for as per my understanding, because previously, if you see over the last 2-3 years, the over collateralization has taken over the subordinate tranche, because over collateralization add to the cash flow both on the EIS side as well as the principal side, which give a more comfort to the subscriber or the investor. But here, if I see on the basis of MRR not included and the cash collateral, the over collateral not including the as a MRR, will affect the transaction going forward, and or otherwise the tranching or the cash collateral requirement may increase going forward.
Correct. I think Sumit also probably mentioned that we'll see more tranching structures. Sandeep, you have any thoughts on this point?
Yeah, I kind of, over collateralization, I would say, is very similar. Equity is like, it's a PTC. So basically, it's like in over collateralization, no instrument is issued, but in equity tranche, another instrument is issued. So we should see more equity, but materially, it seems like equity, like a real investment, will replace the OC. So other than that, there is no material difference. And I think things should be broadly similar for originators.
Correct. So more tranching transactions, basically, where you have a subordinate tranche and you have, or maybe multiple tranches in the PTC.
That is true. That is true.
Right. Great. I think it was a wonderful discussion with all of you, Ankit, Sahil, and Sandeep. I think there is another last question, if we can take. I can see one. I think this question, if Sahil is around, we can ask him. Is Sahil there? I am not able to.
I don't see Sahil in the.
Maybe he got disconnected.
Yeah, appears he got dropped.
So I will just check with Ankit or Sandeep on this. The question is that there has been the latest. I think we know that day before, I guess, RBI came with the revised. I think it was more of kind of just covering the microfinance regulations across the larger spectrum of players, including banks. So that harmonization of regulations that has come in the microfinance sector, will that have any impact? Is there any kind of that we are able to assess that, this new regulations from RBI on microfinance, will it have any impact, positive or negative, on securitization?
Well, really speaking, we have to look into it because it's very early to say, because first of all, you can understand the framework which has been brought for microfinance, and then we can see the effect of that onto the transactions.
Okay. Okay. Sandeep, anything that you are able to conclude?
Yeah, I mean, on face value, if we see, this is a very great regulation in the sense that it places everybody at a level playing field, like you said, the harmonization of the guideline, and it allows everybody the freedom to do the business without being kind of, being categorized as NBFC or banks or MFIs. So essentially, everybody has to work out their strategy and do it in a meaningful manner. So that, I think, is the primary message of the regulation, and it's a very simple regulation, I would say, but at the same time a little more in the coming days to see how it will impact.
Right. Hello.
Yeah, that was it, sir. That was it.
Okay. So thank you so much. I think Sandeep, Sahil is not here, and Ankit. It was a pleasure really to host you and hear your inputs on this whole securitization market. Yeah, I hope it was very useful. I will request Tony to give a validatory kind of a note, and then we can conclude this panel discussion. Thank you so much.
Thanks, Suman. With that, we now conclude our audience Q&A session. Thank you, Mr. Ankit Jain, Mr. Sandeep Singh, for participating and attending our webinar, and also Mr. Mahesh Goyal and Mr. Sahil Mehta, who I think have got dropped. Mr. Mahesh Goyal clearly had some other engagement immediately after our session, or rather midway. I hope all participants have gained important insights from today's webinar. The full recording of this webinar will be available on our YouTube channel, Aquitas Mera, for you to share with your colleagues and industry network. If you wish to know more about Acuity ratings and research, please visit our website, www.acuity.in. We also publish regular research and opinion reports on various macroeconomic indicators. Stay tuned on our social media handles for updates on other webinars and developments. We hope to see you soon again. Thank you so much. Take care. Have a good evening. Bye.
Thank you all.
Thanks, everyone.
Thank you.
Bye.